Hello and welcome. In this lecture video, I'm going to continue the discussion about manufacturing overhead, and we'll do some additional problems revolving around manufacturing overhead and also take a look at a few journal entries associated with job order costing. So again, manufacturing overhead is an indirect cost. That means it's difficult to trace overhead to specific jobs. You can't easily trace overhead. That's why it's classified as indirect, okay? Manufacturing overhead consists of a lot of different items. And so again, that's why it's indirect. And so what we're going to do to push out manufacturing overhead to the jobs is that we're going to use an allocation base. All right, so this, as I was talking about in the prior lecture video, we have our estimated overhead and our estimated allocation base, and we said our allocation base was square footage, and we calculate a rate, and then we multiply that rate times the amount of allocation base used by each roommate. In this case, the roommate would be like the job. When we talk about the allocation base in terms of our choice of the allocation base, it has to be a cost driver. Okay, so what that means is that if a roommate has more square footage, or the more square footage that we have, if that increases utilities costs, then this would be a cost driver. It drives the costs of the utilities. And so that's what we're looking for in terms of the allocation base, okay? It needs to be a cost driver, and then it also needs to be associated with those overhead costs. Some example allocation base that we'll use with job order costing: direct labor hours, direct labor dollars, and machine hours. Okay, so the first step in allocating or applying manufacturing overhead is to calculate the predetermined overhead rate. Okay, we have to calculate the predetermined overhead rate. And the way we do that is we divide estimated total manufacturing overhead divided by our estimated total allocation base. So just like what we were saying up here with our roommates, utilities would be our overhead, estimated total utilities divided by the estimated total allocation base, where the square footage was the allocation base. So that's step one. And step two, we then calculate the overhead applied to the job. How do we do that? Well, similar to over here, where we say, okay, how much of the allocation base did that job use times the rate? How much of the allocation base was used by the job times the rate? So I'll write that down here. We have our rate that we calculated up here. So we have to do our rate first, times amount of allocation base used. Okay? So let's walk through a problem over here on manufacturing overhead. So let's assume that we make a small table that has the following costs. We have our direct materials cost of $300, direct labor $400, and then manufacturing overhead is our question mark. And of course, if we can add up all these, we know that would be the total cost for the job, because we know that the cost for a job composed of materials, labor, and overhead. So we say our company estimates that total manufacturing overhead will be $40,000 and total direct labor will be $80,000, and the company applies overhead on the basis of direct labor. So if we look on that prior page, we take our estimated overhead divided by our estimated base. What's our estimated overhead? $40,000. What is our estimated total allocation base? It's $80,000. This gives us 0.5. What is the interpretation of this? This says that we apply 50 cents of overhead for every direct labor dollar used by the job. We apply 50 cents of overhead for every direct labor dollar used by the job. That's what this means. It's important to attach an understanding or context to this rate, not just take rate times the amount of allocation base used, then to get the answer, but think about what this rate means. And it means that we apply 50 cents of overhead for every direct labor dollar. And that's important to think about it that way because it helps determining how much overhead is assigned to this table a lot easier. If we know it takes us $400 of direct labor to make this table, and we add or apply 50 cents of overhead to this job for every direct labor dollar, what we can do is we can go our 400, which is the amount of allocation base used, times our rate, which is 0.5, 200. So now what's the total cost of the table? The 300 plus the 400 plus the 200, because we know what we mean by total cost of a job is equal to materials, labor, and overhead. So now the total cost is $900. Okay? So I want you to pause the lecture video right now and do this quick check problem, okay? So let me just quickly review it before you jump in there. So our job, WR53, required $200 of direct materials, 10 hours of direct labor at $15 an hour. Estimated overhead, $760. Estimated direct labor hours of 20,000. And they apply overhead on basis of direct labor hours. It doesn't say that explicitly in the problem, but you can gather that, you can infer that by looking, here's the base, here's the overhead. Okay? So I want you to pause the lecture video, and I want you to tell me what is the total cost of the job. Not just the overhead, not just the labor, not just the materials, but the total cost of the job. Okay? Hello and welcome back. Hopefully you got D as the right answer. So let's take a look at that. So remember, the total cost of the job is equal to materials, labor, plus overhead. Our materials are given to us. Our total labor, 10 hours at $15 an hour, so that's $150. And then with our overhead, we have to do two steps. The first step is calculate the overhead rate. How do I do that? Estimated overhead divided by estimated allocation base. Estimated overhead, estimated allocation base. This is telling you that you apply $38 of overhead for every direct labor hour. The problem that we did up here was direct labor dollars. This problem is direct labor hours. It can be either, okay? It depends upon which one's the cost driver. So we take our rate times the amount of allocation base used gives us 380. 200 plus the 150 plus the 380, materials plus labor plus overhead gives us the total cost. Okay? The other thing that I wanted to comment on is when we look at how to calculate the rate, remember it's estimated overhead divided by estimated allocation base. Why do we use estimated? We use estimated, not actual, but estimated or budgeted to make it easier for budgeting and for pricing products. Because if somebody wants this table, somebody has ordered this table from us, and we have to figure out what is the cost of making this table in order to give them a price, well, we have to know how much overhead. Well, in order to know how much overhead, we have to calculate the overhead rate and then multiply it times the amount of direct labor that we think we're going to have. This is why we use estimated to help us develop the rate and then for these pricing decisions to figure out this is what the cost will be, $900, and maybe the price that we charge them is $1,000, which gives us a $100 profit. Okay? So we use estimated, not actual, in terms of calculating the rate. But when we actually apply it, we use the amount of allocation base actually used. We use estimated to develop the rate. The rate's here, and then we multiply that times the amount of allocation base actually used on the job. Okay. So now let's look at some journal entries, and we have a practice problem over here with Wilson Company. Okay. Wilson Manufacturing uses a job order costing system, and let's record the following transactions for the month of October. Okay. So let's review the accounting equation pretty quickly. Remember, assets equals liabilities plus equity. And then what we can do over here with our accounting equation is we can overlay debits and credits onto our accounting equation. Remember, the way I increase an asset is with the debit. The way I decrease an asset is with the credit. The way I increase liabilities and equity is with the credit. And the way I decrease liabilities and equity is with the debit. Okay? So you look over here, let's look at this first transaction and use this diagram to help us. Raw materials purchased on account. Okay, so raw materials, where do we put raw materials in terms of the accounting equation? It is a current asset. Are raw materials going up or down? They're going up because I purchased them, so now I have more, so the dollar value of my raw materials is going up. Therefore, how do my assets are going up? How do I increase an asset? With the debit. So I will debit raw materials for $159. On account. So I did not buy it with cash. On account means AP, accounts payable. Where do I put accounts payable in terms of the accounting equation? It's a liability. My liability is going up. It's kind of like I put it on the credit card. If you bought something on a credit card, your liability is going up. Accounts payable is a liability. Accounts payable is increasing. Our liability is increasing. How do I recognize in terms of debits and credits that a liability is going up? Is with a credit. So then I will credit accounts payable and that's my journal entry. Okay? Now, in terms of raw materials used, so direct, and then we have indirect. In a prior lecture video, I was talking about direct versus indirect. Direct materials go straight to work in process. Direct materials go to work in process. Indirect materials are part of manufacturing overhead. They go to manufacturing overhead. Okay, so work in process. So we know direct materials being used, direct materials, right, 52,000, indirect of 62,000. So where are they moving from? They're going from raw materials to WIP into manufacturing overhead. That's what's happening. Raw materials is an asset account. So raw materials asset is going down because it's moving out of raw materials to work in process and finished goods. So raw materials is going down. How do I recognize that an asset is going down? With a credit. So I'll go ahead and just do my credit first. Raw materials. And I can add these two together of 68,000. I'll cross that out and do that over here. So I have my credit to raw materials, 68,000. My direct go to work in process. Work in process is an asset account. Work in process is increasing. So I will debit work in process. WIP, 52,000. And then manufacturing overhead is a temporary area where we hold our overhead expenses. That's the way I want you to think of it. So what I'm going to do is debit manufacturing overhead for 16,000. So it's a debit to WIP, debit to manufacturing overhead, and credit to raw materials. Thank you.